Welcome to the third part of the Pricing for the Planet week, day one. We hope you enjoyed the first two parts of this first day. Technically, you should have watched the roundtable, which was the first part of this Pricing for the Planet week, day one. The idea was really to explain and to prove that sustainability is not a cost, but sustainability is a competitive advantage, and sustainability can help companies drive financial outcome and financial revenue. So we had, a couple of CEOs, and the idea was really to convey this very important message. And again, sustainability should not be perceived as a cost, but it should be perceived as a competitive advantage. Then during the second part of this first day, we had the chance to interview Nikolai from Simon Kutcher. And because of his new book, The Demand Revolution, he was able to share a bunch of insights and information about this idea that, the market is changing. And what we see is a change from the demand side, which is the first time ever that we see the market changing drastically. So it's a big opportunity for companies because they need to address this demand revolution. So again, I strongly suggest that you watch this roundtable and this interview with Nikolai. And then the third part was really about illustrating our very important concept at Pricing for the Planet, which is the duality between 19th century concepts and 21st century concepts. So what is it? 19th century concept is all those, business or way of doing business that we got from the Industrial Revolution. This idea that, capitalism and a company should be here just to create revenue, and that, every year we should get more revenue. And, this idea of, mark up the traditional way of doing cost plus pricing, all those concepts are from the Industrial Revolution. We need to stop using them, and we need to adopt 19th century concepts, meaning concepts that are relevant to our current, 21st century problems, meaning that we have a big planet problem, we have a big CO2 problem, we have, social problems as well to fix, and we need to have, new concept taking care of this more complex world. And in this discussion with Stefan, we really wanted to illustrate what we call a 21st century concept. And again, you are probably aware, but at Pricing for the Planet, we have created our own learning platform. So you can learn a lot about how to monetize sustainability and how to position sustainability as a competitive advantage. In this learning platform, we really illustrate all those 21st century concepts. But that's enough. Sorry for this long introduction. Let's get right into the discussion with Tensie. So Tensie Whelan, she co-founded the Center for Sustainable Business at NYU Stern. So we are super lucky to have this discussion with her. And I would like to start this session with, if Tensie can really share with you what she would like you to remember from this episode. That's right now. Tensie, thank you so much.
Well, I hope that the audience remembers that sustainability can actually drive better financial performance through operational efficiencies, better risk mitigation, employee engagement and retention, and a whole series of other benefits that we will discuss together.
Perfect. And Tensie, maybe I will let you introduce yourself, and maybe we'll talk about Rosie, right?
Yes, absolutely. So I'm Professor Tensie Whelan, and I am a distinguished professor of practice at NYU Stern. I founded the Center for Sustainable Business there, and the center mission is to help current and future business leaders embed sustainability core to business strategy to drive better societal performance and better financial performance.
Perfect. And it's exactly what we like on this podcast. So first of all, and I think it's not just, me at Pricing for the Planet, but the entire community, congratulations for what you are doing, because really it's inspiring. every time you publish something, we are always, very excited. I think you are driving the conversation. So thank you so much for doing that. And we want to talk about Rosie. So just to give you a context, because at the introduction, I was talking about this 19th century concept from the Industrial Revolution. I was talking about like markup, for example. It doesn't make any sense anymore to use markup like we used to do. Like the single bottom line approach makes no sense. It was good in the industrial revolution time, but not anymore. And I think really Rosie, for me, it's really the typical example of a 21st century. We need more people to adopt it. We need more people to be aware, and we need more companies to use these concepts.
Yes, so maybe I'll share a little bit of what the ROSI concept is. So ROSI stands for Return on Sustainability Investment. And I got interested in this work because prior to coming to Stern, I had run the Rainforest Alliance for 20 years. And I got very interested in all the value creation I saw for every value chain in the partner, from the farmers to the traders, to the brands, to the retailers. So when I came to Stern, we started to do research into what are the drivers of better financial performance when you embed sustainability core to business strategy. And we identified 9 that include operational efficiency, risk mitigation, earned media coverage, sales and marketing benefits, employee relations benefits, operational efficiency, et cetera. And obviously, any kind of good management can drive more innovation or drive operational efficiency, right? But what we find is that sustainability strategies and practices often drive 3 or 4 of those. I mean, they vary depending on what the strategy and practice is. But if you look at circularity, it drives operational efficiencies, it drives supply chain resiliency, it drives sales and marketing and brand benefits, right? Or if you look at climate management and reduction of climate emissions, it drives operational efficiencies, it drives risk mitigation, it drives employee engagement. So there's a whole series of ways that you can start to think about intangibles as well as tangibles to better understand both looking backwards, what was the return on a particular strategy and practices you put in place, but even more importantly, looking forward so that you can do good decision making. Because I think right now companies are doing poor decision making. They're not making the investments at the speed and scale we need because they actually don't understand the full value creation opportunities if they were to really invest in sustainability.
Yeah, and that's a critical piece. And again, I think we both agree. I think we have a big education, lag. So many leaders today are from a generation at the time. It's not, I have nothing against them, but at the time, nobody was talking about sustainability. Nobody cared, and nobody understood the impact. So yeah, there is a lot of work. And again, thanks for what you are doing, because I think you are leading the pack on this one, and it's super important. And one question maybe for the audience is like how Rosie can really help a company to become more sustainable.
Yeah, so the ROSI methodology, basically, so we look at those 9 mitigating factors, but then it starts with sort of what's your strategy, right? So first, of course, company needs to focus on those environmental and social issues that are most material for that company, right? So if a company is focusing on something that really doesn't matter to the business from a sustainability perspective, well, that's nice. It doesn't have any kind of value creation opportunity, and also can be called greenwashing, right? Because it's not something where they actually have an impact on it. So that's the place to start. So we look at a particular industry, a particular company, understand what the material issues are. But then what we look at is, all right, what are the most compelling strategies associated with that issue? And then what are the practices that you can put in place? Because it's actually at the practice level that you start to drive and understand performance. So to give you an example, we worked with an automotive company that their waste management strategy was driving a net positive impact to their bottom line annually of $235 million. This was through things like recycling paint and solvent, because, for example, when you recycle paint and solvent, you're no longer buying the virgin stuff. You're no longer paying the waste disposal cost. And they were selling some of the leftover product. The challenge is that company had no idea that it was making that kind of a net positive impact, because they don't track avoided cost, because they don't track the financial results of their waste management strategy, because they don't aggregate all these benefits back up to the strategy that are happening at that practice level. Another example also in automotive, end of life recycling of cars. So for one company, we found they were netting $100 million because they were putting 2.5% of used car components back into new cars. So they no longer had to buy the new stuff, right? Which also reduces risk in terms of dependency on geopolitical supply chains, right? Geopolitical risk and supply chains. Also, they were selling about 10% to recyclers, and then they were paying to dispose of the rest left over. They had no idea they were netting $100 million on this because they were looking at it as a compliance issue. And I can just keep going on every single, we've been working in apparel, in pharmaceuticals. I mean, I'll give you a pharmaceutical example. And this is an operational efficiency example. And I like this because I think companies understand operational efficiencies, but they don't understand that sustainability is an enormous opportunity for operational efficiency. So in this case, with let's see, what was pharma, right? So they were going to have a loss of exclusivity around a particular product that they sold, which was, I think it was a $1.5 billion product line for them. So really big deal. And normally when you lose exclusivity, you lose at least 60% of your revenue because generics come in with a cheaper product. So they decided to convert to a green chemistry approach for that product. In doing that, they reduced their energy, water, waste, emissions, et cetera, all by approximately 80%. So huge benefits from a environmental perspective. Then we looked at the financial benefits, which came out to about $1.5 million per 100 metric tons of product. What was interesting about that is about half of that money, close to $800,000 actually, was from reduced water costs. Enormous amount of water embedded in manufacturing, and companies aren't really understanding that cost embedding and how those costs are going to continue to increase, and also how they're not going to have access to water. Another area that was super interesting was, obviously there was reduced energy costs, reduced waste disposal costs, reduced chemical costs, but there was also reduced carbon emission fees. In that case, when we were doing this study, they were only paying $5 a metric ton in some jurisdictions. So this was only about $250,000 of saved cost per 100 metric tons. But if you look at the UK, which has $25 per metric ton, you look at Sweden, which is $137 per metric ton, you look at what's happening out there, and that kind of embedded carbon is in so many different products, and companies do not understand that embedded cost, right? And so if you just took the UK cost, that 250 becomes more than $1 million embedded in every 100 tons of products around their carbon. So just to give you an example, the kinds of things that companies are not understanding and looking at to understand the real costs of the production as usual.
Super interesting. And one big question, Tensie, it's like, so where do you start? How do you start using ROSI? Is it from more education, from training? Is it by doing, like a POC somewhere?
Yeah, so there's a couple different ways you can do this. We have open source, we have on our Center for Sustainable Business website, we have a whole open source ROSI kind of microsite with tools and cases and so on. That's all available to people. We also plan to build out an asynchronous ROSI course, which we plan to work on this summer, which we'll be putting up online for people to train themselves. So that's the modest approach. We also are always looking for companies that want to work with us to undertake projects where we can do in-person training of their people, bring together a cross-divisional team to focus in on some areas where they'd like to really understand, either, again, looking backwards or looking forwards, some cases. When we do that, obviously the work generated in terms of related to ROSI is our IP. And we also need to publish as an academic institution a public-facing case from it. But then the company itself gets all its proprietary data and research and training, et cetera, for the company. And sometimes we do it in coalitions with a couple of companies across an industry as well.
Nice. So no more excuses. There is a lot of opportunities to start ROSI. And I strongly suggest the audience to go check the website, because I went there and I think you have a great Excel file with everything. I mean, it's very it's a very detailed work, and you have all the impact. And I think you can do simulation using your own data, so it's very easy to use. So it's really interesting. And on top of Rosie, because I know you work on Rosie a lot, but do you have any other concept or similar idea that you've discovered during your career and during all your research at NYU?
Yeah, we do a lot of other research. So, one area which is related to the business case is around consumer purchasing of sustainable products. So, when I was running Rainforest Alliance, one of the things I kept hearing is that, from chief marketing officers, people say they want to buy sustainable products, but then they don't buy them, or they're not willing to pay a premium. There's this green gap. And so, when I came to Stern, I said, let's research this. And so we did a kind of literature review. And all of the research, 99% of it, was focused on surveys, surveying whether you said you were going to buy, and then whether you actually bought. It was all surveys, it wasn't actual purchasing. So we have partnered with a company called Circana, which collects all of our barcode data at retail for every single product sold in the United States. And they now have access to European data. So we're hoping to be able to do this in Europe. But right now we just have US data. And we've been tracking it now in the US for 10 years. And what we've seen is that sustainably marketed products are generally going twice as fast as conventional at a 28% premium on average. That premium, of course, we have 36 different consumer packaged goods categories. This is just on consumer packaged goods. And this is everything from mom and pop stores to Target and Amazon, everything from bricks and mortar to e-commerce. So everything, like, hundreds of thousands of SKUs we're looking at every year. So going twice as fast, 28% premium. It ranges across the 36 categories. Some get 100% premium. Some are operating at a discount. Most of them are around that 30%, which, having worked in CPG for a long time, I know it is not costing them that. They are making a very nice profit on that. We've also seen the different categories. What I wondered is whether, we look at categories, the sustainable market share under 5%, between 5 and 20%, and over 20%. And I was wondering if maybe it'll just all get stuck kind of in the 5 to 20%. But in fact, we're seeing it, move over into the plus 20%. All the categories, every year we see a couple continue to move over to the right. So initially we had far more categories in the less than 5%. We actually now have the most categories in the over 20%. So just significant growth. We also see demand across all demographics. With that kind of premium, you see less demand from people with lower income and lower education, which is tied to that. But what you see is then when a product is really available and it relates to health, like yogurt and dairy, which people buy for their kids, you'll see every income, every demographic buys the sustainable choice. That index at the 60, in this country, it's sort of 60% sustainable dairy claims and 70% sustainable yogurt. And so it's accessible, even at a premium. I think the dairy is like a 16% premium and the yogurt is a little bit more than that. People are buying it. So anyway, that's another area of research. And then I've also been doing research around with private equity, looking at this value driver question. How can private equity and their portfolio companies, because they have this unique opportunity to really work with improving the operations, right? The operational excellence of their portfolio companies, but they don't really understand the value drivers. And so we've developed a modified strategy Rosie tool that will help them understand, given the material issues for the company, how they might understand and prioritize strategies that would drive societal impact and financial value.
It's always good when private equity firms are, starting to raise the questions and ask around. Okay, so interesting. So yeah, so plenty. I knew about the market share and your partnership with Circana. Actually, we did a podcast episode with a partner of Circana a couple of weeks ago. So super interesting. And I'm glad you have those kind of insights, because today, I'm sure you say that in the US, but we have the fact in Europe where a lot of CEOs are saying, yeah, I don't see the business case. And we are like, how can you say, maybe 10 years ago, you could say that, but saying there is no business case is you did something wrong somewhere. And maybe quick one on this one. So because we have those two kind of like persona. We have the big company, like how can they start this transition? And same question if you are a SME, smaller company.
Yeah. So for the smaller companies, many of those are selling into bigger companies. They're often B2B. And what I'm seeing is, in addition to the significant opportunities in terms of operational efficiency, employee engagement and retention, risk management, which are important for small companies as well, I'm also seeing on the market side that increasingly their customers are issuing RFPs where they're asking for the sustainability credentials, the greenhouse gas reporting, or other types of credentials from those companies. They're also looking for those companies to help them solve for their challenges. So, for example, this is a large company, but just to give you a B2B example, BASF has now developed a wastewater management conversion that produces a lighter solid when you're extracting the solids from the wastewater at the end of an industrial process, which results in significant water savings, reducing cost for their customers, and also produces a lighter, drier solid. So that is less intensive to transport, carbon intensive to transport, so therefore also cheaper. So clients who have to manage wastewater are looking for solutions where they can reduce their emissions, their footprint, as well as their cost, right? So I'm seeing increasingly the smaller and medium-sized companies need to become leaders in this space to be able to meet the demand of their customers. Also, SMEs, if they're selling direct to consumers, one of the ways they can compete with the big guys is to be more nimble about being able to actually offer sustainable products and services to customers. And what we often see, is the companies who do that. If they're looking to be bought by a bigger company, it makes them much more valuable, because the bigger companies who can't innovate and be nimble in the same way that the smaller ones are often buying up. Like if you look at it, it's just sticking with consumer packaged goods, a Unilever or PepsiCo, whatever, they're buying a lot of sustainable small companies to be able to put that into their offerings, but also their DNA. And then finally, you asked about sort of how do we do change management basically in a big company, because that's what we're really talking about when you talk about a big company. A couple of things, right? You need to build, and I say this for SMEs too, you need to build ESG or your sustainability targets into your compensation plan. You need to have your board overseeing the executive leadership on comp and on performance against, because this is one of the ways I tell if a big company is actually embedding it. If they've got their financial metrics that they're being compensated on and not at all on the sustainability, then how real is the sustainability network, right? So that's one area. I mean, I think you do need a chief sustainability officer who reports into the CEO, and creates sort of a center of excellence for engaging and doing that change management around the company. But then you really want to have sustainability functions embedded across the organization, right? In supply chain or in brand or wherever makes sense for that particular company. But you want to maintain that sort of excellence to coordinate, to support, to provide, because this is so changing so fast. And then the other area where really important for big companies is to build a different approach into their capital allocation process. Because another thing that I see is that because companies aren't tracking the financial returns, they balk at investing what's needed to be invested to really kind of pivot the companies. And the sustainability person often doesn't speak the language of finance, which you know very well. And so it's hard for them to make their case that actually this needs a much higher level of investment. So you end up with this kind of internal hurdle rate problem. But there, again, like the analysis is poor. So just to give you an example here, we worked with a company that had made global water stewardship commitments. They used a lot of water in their factories. They had factories in Latin America. One of their factories in Sao Paulo was actually shut down for a couple of days when there was a drought there. When they looked at the financial analysis for their internal hurdle rate, what they looked at for their plants was the cost of the water going in and the cost of the wastewater going out. And the technology was there, but the technology was too expensive in terms of the payback period when they looked just at those two factors of reduction of water going in, cost of water going in, the reduction of the wastewater cost. They were not looking at the potential risk that they had when they had a stranded asset in their factory, which we actually monetized. We found out how much it cost. It was quite significant, and we built in a probability of that potentially happening in this particular case. They were not building in the cost of the energy to move all that water around, heat and cool it. And they were not building in the fact that they were paying $1 million annually for a permit to allow them to go over their water allocation if needed, which they no longer would need to. So there was just so when they put all that in, then, they can meet their internal hurdle rate. So there's some real challenges around that, in terms of change management, investment, the companies need to focus in. And there's a lot of other things I could go into, but those are some of them.
So it's super interesting, especially because we have a lot of chief sustainability officer, and they're coming to us saying, I don't know where to start. The task is so huge. And I like your very pragmatic approach, which is, let's be smart on what we measure. Let's be granular, because actually it's common sense. But we need to have the data, we need to have the knowledge and the understanding, but it's common sense at the end.
Yeah, it is. But they're not used to, I'll give you another example. Pulp and paper company here in the United States. They operate in the southeast of the United States. They don't pay for water, unfortunately. And pulp and paper uses an enormous amount of water. So the chief sustainability, and it's not a risky area in terms of water. So the chief sustainability officer was saying to the mill managers, hey, we need to look at water. They said, why? It's free. He did the analysis anyway. What he found out is all that free water was costing $1.5 million per plant to heat and cool and move it around and to pay to dispose of it. So free water, because they have this idea of this stuff is free, actually has all this embedded cost that they're not understanding. Right. So again, just, it's just fascinating. Every single example we get into, we find that people they don't have the right lens to think about it. Right.
Yeah, absolutely. No, for sure. 100%. And maybe, so one question off script, it's because I'm really interested, because in Europe, we have the CSRD, we have a lot of regulation coming. Do you think that it will happen in the US as well? Or or it's happening already, or do you see similar trends?
California, which is one of the fifth or sixth largest economy in the world, does have regulations. The SEC regulations already in lawsuit and already being held up. It was also weaker than what most companies are going to have to comply with in California, and for the CSRD as well. It also depends on what happens in our elections in the fall.
Of course.
That said, while I am supportive of the need for a much more rigorous, harmonized and transparent set of reporting metrics, what I am seeing that I am very concerned about is that these reporting metrics are process and output based. In other words, do you have a policy on X? Have you trained X number of people? None of which tells you anything about the actual impact on society, nor does a policy or people trained actually necessarily result in financial performance improvement, right? So I'm really concerned about the nature of the metrics, because what we're seeing increasingly is that people are managing to those ESG reporting metrics, as opposed to designing their sustainability strategy, designing their KPIs, figuring out the financial benefits, tracking those, and then mapping them to the ESG reporting metrics. And in fact, I've had many CSOs tell me, my organization is now requiring me to move all of my money that I get. It's just like a zero-sum game. I get, $1, and the dollar now has to be spent 100% in reporting and compliance, versus before I got to spend it 50-50, So this is a big deal, and I'm really concerned about it. But I'm not to say that we should. I appreciate the leadership that the EU is showing with CSRD, but I am concerned about the perverse incentives it might create.
Oh, absolutely, yeah. And I think it's one big thing we are trying to push with Pricing for the Planet, which is, yes, you have the regulation piece, but you need to go way beyond the regulation. It makes no sense. And you cannot turn sustainability into a competitive advantage by just, following the regulation.
Right. Yeah, you can't.
Absolutely. And last question, but this one is almost like a philosophical question, Tensie. So, but I love this one. So, what is a common misconception that people often believe to be true?
I think a common perception is that investing in sustainability costs more than it returns to you, and that business as usual is less risky than investing in your sustainability transformation. And I think that both of those things are stupid. So, but that business as usual is a real problem because people go with what they know. And they're like, okay, well, it's worked now. So, and like, if we have to go invest in all these things we don't really understand and put all this money in, and we're not really sure how it's going to turn out, why don't we just stay with something we know? But that is, in this environment, like with everything that's happening in the world, that is a really problematic approach. And by the way, they're not taking that approach with AI.
Yes.
So, right. So why then take that approach with sustainability, which is actually even more existential, much more existential than to their performance, honestly, than AI is.
Absolutely. Tensie, a huge thank you. Maybe one last question. It's more for the audience. Where can they follow your work? Should they follow you on LinkedIn? Where can they get more information?
Yes, please reach out to me on LinkedIn. I have nice 15,000 strong. I'd love to get more people on that. So yes, I'd love to connect with people on LinkedIn. And of course, they can feel free to go to our website for a lot more of our research and coverage. We also have a mailing list, so they could sign up for our mailing list on the webpage, and then they'll get invited to our conferences, events, etc.
Absolutely. And you just did one conference that was really lovely. So I strongly suggest that that the audience follows, what you are doing because it's quite impressive. And you start to know, Pricing for the Planet. So you can go on our website, www.pricingfortheplanet.com. We also have a newsletter exploring the intersection of business and sustainability. And we are trying to still with pride, as we say at Google, what you are doing at NYU. So we try to kind of like share the big news. Tensie, a huge thank you again. It was very, very interesting. And I will wish you a great day because it's night here, but I know you still have a part of your day to leave.
Well, Fabian, thank you so much. It was a real pleasure talking to you, and congratulations on all the good work that you're doing as well.
Thank you.